Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 164, and it's been a busy week. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, Keith, apart from the obvious, what have we got this week? Can I just say I'm sitting on my boat in sunny Portsmouth with a howling gale and pouring rain all around me.
Welcome to the English summer, Richard. So before we get going, this week on Wednesday, we will be having another one of our regular chats with Rogue Trader on the Discord, the last one before the autumn. So that's this Wednesday at 7:30. Hope to see a few of you there. Okay, the big news for the UK is that it was election day yesterday on the 4th of July, and this is the latest data from the BBC as of Friday morning, and Labour appear to have won by a landslide, although frankly not quite as much as they had been expecting, I think. That's a majority of around 84 currently, with 16 seats to go. Conservatives have been absolutely decimated. The Liberal Democrats have done well. The SNP have also been decimated. So big changes in the UK. Now, elsewhere, after last Friday's absolutely disastrous debate in the US, Joe Biden has stayed in the race and has been quite stubborn in resisting calls to drop out. His odds of winning have dropped sharply, and the odds of Donald Trump winning have risen. Be afraid. Elsewhere, the US Supreme Court has ruled that the president is immune from prosecution for deeds committed in his official role, handing Donald Trump some good news, and all the good news seems to be going his way at the moment. We had the first round of the French elections for the National Assembly, and the right-wing Front National gained the most votes. The second round is this weekend. Markets have rallied, as it appears that there'll be a lot of tactical voting in the second round, and it's likely to be a hung parliament, and the National Front, the Front National, will not gain an overall majority. The Bank of England has warned that 3 million UK homeowners still have mortgages below 3% and have yet to feel the full impact of interest rates. Monetary policy takes a long time to feed through. Interest rates in the UK are still at their highs, and that is still tightening. Good news, on the 1st of July, the UK energy price cap fell by £122 to £1,568. That's good news for inflation and for cost of living. And elsewhere, we've had Hurricane Beryl. We've been warning that the temperature anomaly in the North Atlantic is at a record, and Hurricane Beryl is the earliest recorded Category 5 hurricane. So there's a lot of energy built up in the North Atlantic, could have a terrible hurricane season. And finally, oil has risen during the week on tensions in the Middle East as Hezbollah attacked Israel. So some charts relating to the news. This is the result after the first round in France. The right-wing Front National got 34.5% of the vote. The Socialists got 28.5%, and Macron's party came third. He is going to struggle to get anything done. Now, reminder that both the Front National and the New Popular Front, the Socialists, have campaigned on manifestos of increasing the French deficit. And the purple line is what would happen to the deficit to the national debt if the socialists get in. The blue line is if the right wing executed their plans, both of them very bad. They'll be in conflict with Brussels. Let's see what happens. But markets are more optimistic about the French elections. They think that there won't be too much disruption. The yield premium of French bonds over German bunds has fallen in the last few days. And moving to the US, well, this is the lead of Trump over Biden in the opinion polls. And after the debate last week, Trump has surged. Now, the CBO has revised its forecasts for the US fiscal deficit this year, and they've revised it up from an already enormous 1.5 trillion to 1.9 trillion, or 7% of GDP. Markets are worried by a Trump victory. The US needs to get the deficit under control, and Trump is showing no signs of wanting to do that. And this is the outlook for the US fiscal deficit. And you can see bottom down here that it's running at 7% of GDP ad infinitum. And markets are pricing in the first rate cut in September now. And this is the UK. This is the energy price cap, and it's been coming down, but it's expected to rise again this winter. Elsewhere, the yen is selling off, has moved decisively above 160, and freight rates continue to rise as importers are trying to get Christmas goods in, and we still have a lot of disruption in the Red Sea. Okay, and on to this week's economic data. So, quick summary, the UK is stagnant. We have a new government. What can they do? The EU is stagnant, both showing little signs of growth. The US remains strong, but as you will see, there are increasing signs that the rate of growth is slowing. China, difficult to tell. On to the UK, Richard.
Thanks, Keith. So nationwide house prices month on month increased 0.2% in June, and year on year up 1.5% in June, which actually is not very much.
True, and less than the rate of inflation. So in real terms, they're falling.
Yeah. UK Bank of England consumer credit was up 1.4 billion in May. So consumer credit has been rising actually for the last 3 years.
Yeah. I'm surprised, actually, given the high rate of interest rates, that consumer credit actually looks absolutely fine.
Yeah, UK mortgage approvals at 60,000 in May. So fairly steady at that figure for the last couple of months.
Yeah,
A
and
little bit below
actually,
long-term trend.
yeah, but not that far down on 2019.
Yeah.
Really amazing, given the rise in interest rates.
UK net mortgage lending just slightly above zero, which suggests the housing market is not particularly dynamic.
Yeah.
Well, obviously net lending takes into account repayments as well. UK net lending to individuals, 2.7 billion in May. Not unhealthy, I would say. UK global construction PMI at 52.2, so positive.
Yeah. But fading again. So has shown unexpected strength.
Yeah.
And I think there's probably a bit of over-optimism creeping in.
Yeah. New car sales year on year, 1.1%. And actually, that doesn't really look particularly out of line with the characteristic shape of that graph, which has got that semi-annual peak as the new registrations come in.
Yeah.
And the economic surprise index is there. Indeed, job postings index still gently falling.
Yeah.
And UK true inflation also falling. Actually, only 1.1% this week.
Yeah.
So that is,
To explain this, Richard, I think,
hmm,
one of the things we've complained about Trueflation before is that they often revise the entire data series.
yeah,
And frankly, this week, I think they've totally shot their credibility because they've now revised the entire back history, and they have the UK experiencing deflation last November.
the problem is if you revise it, it's no longer Trueflation. It's
Yeah.
something else.
Yeah, I don't know what this is. So this is last week's, yeah. So last
Yeah.
week they had Trueflation in November last year at 6%. This week they've got it at -1%.
So it's a useless data series.
Yeah.
Perhaps we should not have it anymore.
I think we're going to, so this is the last week we're going to have it for the UK. I think
Yeah.
we'll talk about the US, but this is just totally unreliable.
Yeah. So in summary, very little data this week. The UK economy really is stagnant and showing little sign of recovery. And we've got quite a lot more interest rate rises that will feed through into fixed rate mortgages when they come off their fix. Still to come.
Yeah. Thank you, Richard. And on to the EU. So we had inflation numbers for June and they were okay. So CPI month on month came in at 0.2% in line with expectations. Year on year, falling to 2.5%. That is, in the historic range, but not coming down towards 2%. The bad news was core CPI missed expectations and was unchanged on May. Month on month, core was 0.3%. That's too high. And the problem, once again, was services inflation. Services inflation is 4.1% and just not coming down. The ECB will not be cutting rates until service inflation starts to come back in line with target. The construction PMI faded again, and that is a really terrible number, falling to 41.8 from 42.9 in May, well below expectations. Expectations had been for it to strengthen. So that is towards its cycle lows. The Eurozone construction market continues to weaken from already weak levels. The Citigroup Supplies Index is negative. Job postings in Germany continue to drift off, as they do in France. So EU summary. Inflation in June came in line with target at 2.5%, slowly fading towards 2%, but service inflation remains sticky. Job postings continue to decline. The EU economy is stagnant. Let's see what happens after the second round of French elections. And on to the US, Richard.
Thank you, Keith. So US JOLTs, job openings, still in that steady decline that it's been in actually for several years. So it was at around about expectations, slightly above expectations, but I think the decline is interesting.
Yeah, you notice they revised down the April number.
Yeah.
So
Still above pre-COVID levels though, and
yeah,
the JOLTs job quits rate is also on a downward path, suggesting, and now it's actually dropped below COVID levels, pre-COVID levels, suggesting that people don't want to leave their jobs. A bit of job insecurity. The rise in JOLTs was due to government job postings, so that's where the government is spending your taxes.
yeah, that's little jump last month.
Yeah. And still, according to Bloomberg, still remains 1.2 jobs for every unemployed person.
Yeah, so the jobs market in the US remains tight, but it is slowly weakening.
Yeah. According to the beverage curve, we need to expect the number of job openings to fall before we expect the unemployment rate to rise.
Yeah, so we're here. It needs to fall actually by quite a lot more before we see a systematic rise in the unemployment rate.
Yeah. And the change in pay for job movers is below what it was in 2019. So actually, moving job doesn't get you a big uptick. Now it gets you a decent chunk, actually, 10%.
It does.
Not the 20% you were getting pre-COVID.
Yeah.
Post-COVID, sorry.
That's good.
And LinkedIn and indeed job posting indices continuing to fall.
Yeah. So although there's a little bounce in JOLTs this month, the other more up-to-date indicators suggest the labor market does continue to weaken in the US.
Yeah. And job openings, unfortunately, in the past 17 months have been revised lower. So the BLS is consistently. So presumably we would expect on the basis of this to see this month's job openings revised lower as well.
Yeah.
US challenger job cuts, which reminder is where we have large layoffs, pretty low.
Yeah, actually, so companies are not shedding staff. They're just not hiring.
Yeah. And the ADP employment change, 150,000 in June.
Yeah, now reminder, it's non-farm payrolls date today, so out later.
Yeah. PC inflation month on month at 0 and year on year 2.6%.
Yeah, these are great numbers, PC inflation.
And core PC inflation month on month at 0.1%, revised up in April.
Yeah, but still, the May number is a good number.
Yeah. And year on year, core PCE is at 2.6.
Yeah, steadily coming down towards target. So PCE inflation in May was actually slightly negative. And what's really reassuring is that there was a sharp drop in services inflation, which was only 0.12% month on month. Goods inflation was negative, but service inflation does appear to finally be slowing. And what there was of services inflation was entirely due to healthcare and housing, both of which we know are, well, in the case of housing, it's lagging due to OER, and healthcare is an ongoing issue. Basically, it's a health insurance, and is that susceptible to monetary policy? We ask ourselves.
Personal income month on month was up 0.5%, which is quite
Good.
substantial, actually. And personal spending month on month was up 0.2%, which should mean the savings rate is increasing.
Yeah.
And there's a divergence forming, well, has formed between spending trends since the pandemic. So pre-pandemic, the services, durable goods and non-durable goods trends are all pretty much aligned with each other in terms of their rates of growth. Now they've really significantly diverged, haven't they?
They have. I mean, we have had more services inflation. Perhaps people are just going out less then.
Yeah.
Not going to restaurants because it's too expensive.
Yeah. Construction spending month on month was down 0.1%. First time in a year it was negative. Although when revised upwards substantially in April.
Yes, exactly. So we thought that construction spending had actually fallen in April. Well, it didn't.
Yeah. And ISM manufacturing PMI at 48.5. It's sort of steady-ish at that level.
Yeah.
Just below 50. And ISM manufacturing employment is just around 50. Sort of nothing to see here really with ISM manufacturing new orders, just around about 50. And ISM manufacturing prices paid, quite a spike down there.
Yeah, that's good news.
Yeah. US factory orders month on month, down 0.5, revised downwards in May as well. So that's a little bit on the low side, but there are months where it is substantially down. So unremarkable on its own.
So that's the May number. The April number was revised down.
And factory orders ex transport month on month. Again, that's down, but not out of kilter with other months as yet.
Yeah.
ISM services PMI at just below 50.
That's quite a sharp drop, though.
Yeah.
That's actually new lows for this cycle.
That is, isn't it, Keith? Yep. Lowest it's been since COVID.
It's noisy, though. There've been other spikes downwards that have bounced back.
Yeah. And the ISM and the S&P Global Services PMIs are diverging sharply. And they were a bit divergent, weren't they, pre-COVID? They were
Yeah.
consistently divergent, really. And then they became very convergent. Then they diverged, then they converged, and now they're diverging again. But it's quite a big divergence.
It is, yeah. So, S&P Global Services PMI shows the economy strengthening. ISM shows it weakening.
Yeah.
Not great.
ISM services business activity. I mean, that's a very big, noisy move, and you wonder whether there's something going on there, actually.
Yeah, this is noisy.
And ISM services employment, again, it seems to be moving downwards and developing a bit of a sharp downtrend, 46, as an expectation of 49.
Yeah, that's a bad number.
And ISM services new orders doing the same thing. Expectations nearly 40, 54, actually 47, and a sharp spike down. ISM services prices paid at 56.3, so not going up, not really going down either.
Yeah, but it's consistent signs that inflation is coming down in prices paid.
Yeah, and there's quite a decent correlation between the ISM services PMI and discretionary services expenditure, particularly actually in the last couple of years.
Mm.
Yeah, the ISM composite PMI is hovering at levels that it normally gets to around about recession time, and it is just dipped below that dotted red line. And the RCM TIPP Economic Optimism Index is at 44, and if you look at the pre-COVID trend, that would indicate a happy level of around about 47.
Yeah, not too bad.
Yeah, Chicago's PMI at 47.4, which is a big jump up, which contradicts some
Yes,
just
exactly.
And Redbook retail sales, they're fine. It's just ticked down a little bit this week, but
yeah,
if there's any problem there. US the 30-year mortgage rate 7%, so it's hovering at that level still. And the mortgage purchase index is at 142. But the thing about this chart is looks like it's quite a big drop from last week, but actually it's within the noise band.
Yeah, absolutely. But in the grand scheme of things, it's pretty dead.
Yeah. Initial jobless claims 238. So unremarkable, but a little bit higher than a year or so ago.
Yeah.
US continuing jobless claims spiked up. Interesting.
Yeah, but in perspective, it's not a big jump.
No, is it the start? I mean, there is a trend from April, isn't there, Keith?
Yeah.
Increasing each week. There hasn't been a week where it's dropped. I don't think, just looking at it. So is it the start of a upward trend in continuing jobless claims? And as it says here, they are slowly climbing.
So the top right is versus the pre-COVID average. So without all of the headline numbers we've just shown you include seasonal adjustments, etc., etc. We just look at the pre-COVID averages. You see it's climbing, but it's not actually that elevated.
Yeah. The Dallas Fed weekly economic GDP estimate is at 2.4%, same as last week, and that is actually quite level. And the Atlanta Fed GDP now for Q2 is 1.5% this week, 3% last week. I find this particular chart quite unhelpful.
Yeah, it's too volatile.
Yeah.
I mean, what on earth can have caused them to halve it in 1 week?
Yeah, exactly. New York Fed GDP now cast as at 1.9. Let's call it 2%, basically, and roughly speaking, same as last week.
Yeah, more reliable.
Yeah, the St. Louis Fed GDP now cast only at 0.76%, which is on the low side of all those estimates.
It is. Now, this is the first time we reported this, but to point out that the St. Louis Fed are the ones that actually got Q1 right.
Yeah.
They had Q1 at 1.7%, whereas everyone else was too strong. So anyway.
And the US Economic Surprise Index is falling quite sharply, I think.
Yeah.
I believe those job postings have something to do with it. Indeed, job postings index continuing to decline.
Yeah. It's just a steady, slow decline.
Yeah.
Not precipitate, but not,
What's Lightcast calculate?
So Lightcast also look at online job postings, and actually they're look at the blue line. So they're not saying job postings are continuing to fall. They're saying it's kind of stabilized.
Yeah. What's the purple line? Oh, previous 12
That's
months.
last year. Yeah.
Yeah.
So there is strong seasonality. According to this, there's quite strong seasonality in job postings.
Yeah.
And in the second half of the year, you see them decline. Let's see.
And according to Paycheck, wage growth was weak in May.
Yeah. So Paychecks looks at actually company payroll. So they've got very good data.
Interesting. And their sort of Paycheck's job index bounced a little bit in May, but has been on a downward trajectory for the last couple of years.
Yeah. Yeah, that is it's now below pre-COVID average.
Yeah. US true inflation 1.86%.
Now, question, Richard, do we retain this next week? Do you believe this number?
I think the problem with it is for me it's difficult. I mean, I think all inflation figures are difficult to have. I think as long as they're not adjusting it like the UK one is being adjusted, which basically renders it meaningless, I think it's useful to have it.
Okay, right. We'll keep
What
this
do you
one.
think?
The bottom line is they do adjust it backwards. When they adjust so the whole back history will change every week. But I think they've got much better data for the US.
Yeah.
And so, what's happened in the UK trueflation this week is just absolutely idiotic.
Yeah. Think of all the time we've wasted commenting on it. The US real disposable income growing at 1.1% per annum, which is below its long-term average of 2.6%. And the savings rate remains very low by historic standards.
Yeah, so if that picks up more towards normal levels, you'd expect consumer spending to fall further.
Yeah.
The alternative I'd thought is that retiring baby boomers mean that the savings rate will be systematically lower going forwards.
So net interest costs account for almost 40% of federal revenues by 2052 currently. This is obviously a projection currently.
Yeah.
At around about 12%. And obviously that's not sustainable, so it won't get there. What will happen is the question.
What will happen?
And when?
Yep.
So the US economy is still strong, but there are some signs that it's cooling down a bit. And the points above are there for you to read. So is it heading to a recession, Keith?
I think it's certainly slowing down.
Yeah.
So let's wait and see, basically. But it's gradually losing steam. Now, the way things in the Sun Also Rises by Ernest Hemingway, he's asked how his company went bust. And he says, slowly, then quickly. And that's the way recessions tend to work. So it depends whether the feedback loop of job losses leads to drops in aggregate consumer spending. Now, normally the way that works is that the construction and the manufacturing sectors, the cyclical sectors, they lose jobs, and the people who've lost their jobs cut spending, which leads to a cascade of job losses. Now, we know in the US that construction sector has been amazingly strong despite high interest rates. So that feedback loop has really not got started. Will it start? Don't know. Let's wait and see. On to China. So this week we had the private sector Caixin PMIs. The manufacturing PMI ticked up slightly to, actually, by historic standards, a pretty decent number. The services PMI, though, fell quite sharply to 51.2. PMIs are noisy, but that's not portraying a strengthening Chinese economy. So as a result, the composite fell to 52.8. Okay, not great. Chinese property prices fell 0.7% in May. Now, I'm really not sure where you're getting this data from, but house prices still falling, and actually that seems to be accelerating falls. Not good for the construction sector, which has historically been a big part of the Chinese economy. So very little data this week. Caixin PMIs were generally soft. Okay, and on to errors and correction. So last week, I did a short piece on how bond issuance affects the money supply, and regular viewer, Mr. C. Peckham, got in touch once again to correct me. So last week we talked about how the purchase of government bonds affects the money supply. The money supply increases only if they're bought by banks, not by non-banks. And the bottom line is this is a small effect, and I got the causality slightly wrong. So to go run through it again, thank you very much to Mr. C. Peckham for correcting me. Scenario 1, the Treasury bond is bought by a non-bank. So the Treasury issues a bond bought by a private individual or corporation. They pay the Fed $1,000, which it then transfers to the Treasury. The individual has lost $1,000, but has now got $1,000 in assets, like government bond. The Treasury has $1,000 in cash, which it can spend, plus an increase in its liabilities of $1,000. The cash has circulated. There has been no increase in the money supply. But that changes if the bond is bought by a commercial bank. The bank pays the Fed $1,000 in cash from its reserves at the Fed. So the bank loses $1,000 in reserves, but it has $1,000 in assets, i.e. government bonds. The Treasury has $1,000 in cash, which it can spend, an increase in its liabilities. But because bank reserves are not part of M2, the money supply has increased by $1,000. So if the bank who has bought that bond were to sell it to an individual, then the bank would now have an increase of $1,000 in its reserves of the Fed, and the individual would have lost $1,000. So the increase in the money supply that would have occurred because the bank bought the bond is eliminated if it's subsequently sold to a non-bank, like an individual or corporation. So this is all a function of the banking system. Two key points. Although there is a notional difference on the money supply between the two scenarios, if the bond is bought by a bank or non-bank, in reality, the effect is likely to be limited, because if a non-bank buys the bond, is probably from savings, and that money would not have circulated anyway. And two, there is little relationship between changes in commercial bank holdings of treasuries and M2. Take a look at the chart. Apart from around recessions. And as we've talked about before, there's little relationship between M2 and inflation anyway. Bottom line, this is a relatively minor effect. Pause, have a read. So final point is this is all a side effect of fractional reserve banking. So money is created by banks when they lend out reserves. Pause, have a read. But actually, final point is that there are limits to how leveraged banks can be. And so the more they lend to governments, the less potentially they can lend to corporates, meaning that there's crowding out potentially if the budget deficits if there's too much government bond issuance. Which, was that clear?
Yes. I mean, banks create reserves when they lend money as well, don't they? Actually, so if a bank lends, the double entry in the bank's book is credit assets, debit assets, credit liabilities,
Mm.
and the asset goes to its reserve. So it is quite complicated. This is the effect of buying government debt, but
Yeah.
banks can also create money ab initio just by lending and building.
Yes, that's true. But then they have to set aside reserves. They can't lend out.
Yeah, but they
So
don't have to set aside 100% of their reserves. They
no,
set aside a percentage of it,
yeah,
and that's
that's
how they
true.
go bust when they do too much of that.
Yeah.
Well, it's one of
Well,
the ways they can go bust.
that's right. If the government were ever to restructure its debt or default on its debt, then the first thing to go bust is the banking system. So when we're talking about the unsustainability of the US fiscal deficit, then the one thing that's very unlikely to happen is default. Inflation, much more likely to happen. So last week, Richard and I were talking about migration, and while I was on holiday, I've read The Social Limits to Growth by Fred Hirsch, 1973. And he argues essentially that rising GDP will lead to falling incremental rises in people's welfare because there are social limits to growth as well as physical limits to growth. So when people talk about limits to growth, the Club of Rome, 1970, was it 73, talking about how you cannot have exponential consumption of a finite asset such as coal or oil. And so they were worried that the GDP growth would falter and that we'd have rising poverty rates around the world as we started to run out of oil and coal, etc. That hasn't happened. Hirsch's argument is different. He's saying that higher economic growth creates social congestion, which actually lowers welfare as consumption increases. So he breaks down goods and services into two types. So there are material goods and services, which are potentially unlimited in supply and whose consumption is not subject to any constraints. So let's think about shirts or bread, running water, etc. As our GDP rises, everyone can have more shirts. But his point is that actually a lot of the things that people want to consume are positional goods, and these are subject to physical supply limits or social supply limits. So, for example, physical supply limits, townhouses in Kensington, the Lake District, the M25. Basically, lots of people would like to go to the Lake District. The more people who go to the Lake District, the more it becomes crowded, and that reduces everyone else's enjoyment of the Lake District. The same for the M25. The more people have cars, the more congestion it is. So the marginal car actually reduces the utility of having a car. Social supply limits, boxes at Wimbledon, knighthoods, the number of CEOs or senior management roles, Lamborghinis, positional goods of any kind. So let's take an example of a physical limit. Driving in central London. The marginal new driver in London is expressing their preference to use a car for that journey. So they are, by definition, their utility has risen. But every new marginal driver increases congestion and reduces the marginal utility of everyone else's journey. There is a physical limit to the capacity of the road system in London. And another example he gives is education. So we have in this country massively increased the supply of graduate and postgraduate students, but the number of senior management roles which they aspire to fill is relatively fixed. There's a social constraint on the supply of management roles. And so therefore, the excess supply of graduates means that businesses simply have to do more work to find all the applicants they require out of the increased number of graduates. Similarly, applicants face extended and tedious interview processes as they try and find a job. So more education does not lead to a better outcomes for the workforce or graduates. It simply adds costs and leaves a lot of graduates with debt and poor job prospects, or they cannot get the job they aspire to and are qualified for. Example 3, status. And this is a big one. So a lot of the goods and services that people aspire to are positional. They signal the status of the individual within society. That's why you see so many Gucci handbags, etc. these days. And the problem here is, as the price of status goods rises, so people have to compete more and hoard more money to signal their relative status, and they become less willing to pay taxes because their marginal, the marginal utility of their wealth remains high. They need to signal their position to other members of society. And if you look at the UK society over the last 30 years, over my lifetime, when I was growing up, my parents were very clear to me that if I had money, I was not to flash it around which would just upset other people and make them jealous. How I behaved mattered for the welfare of society. Now, what's happened over the last 30 years is we have adopted an American model where everyone needs to show off their status relative to other people. You just look at the cars that are being driven around in London, or the growth of luxury goods. Society has flipped from one where the individual tried to behave in a manner that kept the social fact, that preserved the social fabric, to one which emphasized personal status within that society, and with the social fabric being very much a secondary thought. So bottom line is, Fred Hirsch argues that rising economic growth will create declining marginal welfare because of physical and primarily social limits to the supply of goods and services people to aspire to consuming. Not everyone can get rich. Richard, your thoughts?
Yeah, it's interesting, isn't it, Keith? I mean, it's true as well. As everybody moves up the ladder of their physical possessions, then the physical possessions become less desirable, and something that is rarer becomes more desirable. And it's partly a product of a society that's becoming more wealthy, and it's partly to do with how people think about themselves, and probably social media has an impact on that. So I mean, the problem with it is you take it ad absurdum, along with a continually rising population, is that ultimately everybody's deeply unhappy because nobody can have anything.
Yeah, I mean, the problem with Hirsch's analysis, frankly, is he doesn't have any solutions to this.
No.
So, if you think about what's happened in central London, the example I gave about roads and increasing congestion, the answer is to raise prices, to put in a congestion charge, which defeats the object of GDP growth and rising wealth. Essentially, what you're then doing is saying, okay, rising wealth meant more people can have more cars, so we're going to raise the barrier again and exclude the poor.
Yeah, it makes it more of it exacerbates inequalities in society.
Yes, absolutely. And the other thing is, when we talked about education, well, does Hirsch actually overstate social scarcity in that although there's a limited number of management roles in the economy, there are lots of jobs that require higher education. And, the country as a whole, although there is misallocation of education towards, low-paying media degrees, etc., overall, this economy is a high skill service economy which needs highly skilled graduates. So anyway,
well, yeah, but so just as you then run into the issue of particular skills that it needs, particularly it needs numerate and
yes,
scientific technological skills, and a lot of people either aren't interested or aren't willing or aren't capable of developing those skills.
yeah. So, but that's a question of the misallocation of educational
Yeah,
resources rather than producing too many graduates. We should be
that's right.
producing more useful graduates rather than,
Like you and I were, Keith. I was a
yeah.
useful graduate. I like to think anyway.
Now, discussion on silver, I'm afraid that we're going to delay that until next week. Thank you all for your suggestions on silver companies.
So just going to have a quick look at AI costs. We're all aware of the fact that AI uses an awful lot of electricity, and that there's a Google search costs 10 times as much if it uses AI than if it doesn't. It costs Google 10 times as much. So visual capitalists have estimated the cost of training an AI model on each generation of AI software, and the cost rose 20-fold between ChatGPT-3 and ChatGPT-4, or GPT-3 and GPT-4. And one of the biggest costs is the additional hardware needed. So it now costs let's call it $200 million to train Gemini Ultra. An estimated cost of training that. So it is a non-trivial amount of money. These are the so ChatGPT training cost was this is 40 million, isn't it, on the bottom line?
So yeah, ChatGPT 2 was 40,000. Then 3, 4.5 million, 400 million, 5, 2.2 billion.
Yeah, which is astronomical. And
Yeah.
also, I wonder if GPT-5 is going to be better than GPT-4. I mean,
Yeah.
I think I'm an AI cynic in sense. I think in some things it has a great deal of utility. For a lot of things that it's being put forward as useful for, I think it has less utility. I've noticed, this is an aside, but since Google started using AI searches, I believe the quality of the searches has gone down, not up. Maybe it's the things I search for, but I don't like it. I don't actually I get too many adverts and not enough information about what I'm actually looking for.
Well, I just think this has to be wrong because that's unaffordable. And so nobody would do it.
No. How much does it cost to train a baby?
A lot of money, actually.
But not 2.5 trillion.
No.
So there we have it. Training AI models is an expensive thing, and the more expensive they get, the more it'll be isolated to the really big companies. And is that a good thing? We ask ourselves.
Well, is this, in order, if you're going to cost you $1 billion, let's say, to train the latest version of a ChatGPT model, what sort of added value does that have to produce? It has to produce 3 billion, of added value. I'm very skeptical that this is going to provide value for money.
Yeah, I think we will see, won't we?
Yeah.
The missing impact to the missing impact of AI. Chatbots, they're one of the early applications of AI, and this is a chart that shows their usage. So percent of companies using AI is currently sort of, what do you think, Keith? 5%, probably 4 to 5%. And in the next 6 months, it's expected to be, let's say, 6.5%.
Yeah. These aren't huge numbers and they're not growing.
No. So although you could say the past 2 weeks has grown from 4 to 4.5, 4.75, yeah, over the last year and a bit. We shall see. Anyway, there's a question mark over what the rate of growth is at the moment. And the share price of AI tech companies have, as we know, exploded higher, but the end users, i.e. the ones in red, the share prices haven't this is a classic example of the particular technology. And I don't know whether AI is this technology yet, but it's a classic example of a technology being essential to maintaining your competitive position. And you might say that's email or using electronic accounting software as opposed to paper books and records. But that by using it, you don't actually gain much of a competitive advantage because all your competitors have to do it as well. And the profit, the benefit goes to the businesses that are successful suppliers. But of course, if you have a lot of suppliers, then the cost pressure, competition amongst the suppliers also forces down the price. So you then end up with basically it becoming merging into the economy is just another factor in the economy with no super profits. Now, whether that will happen with AI, the jury is out. But certainly, what this is suggesting is that if you use AI, you don't gain any massive investment benefit in terms of your share price, which presumably is related to your ability to generate earnings.
Exactly. So the market's saying it doesn't see any boost in earnings for the AI beneficiaries.
Yeah, it doesn't mean to say you shouldn't do it. It does, but it does mean there's a price. There's a price that you can pay for it and a price that you can't pay for it. So the displacement of white collar workers by AI doesn't yet appear to have happened. And we got this graph, which if we ignore the COVID spike, since the end of the GFC, let's say 2012, it's been on a fairly steady rising trend, just from between 61 and 62.5% as a percentage of employment. And certainly, at this stage, I have seen no example of where AI would displace a white collar worker. You see examples of where it might improve their efficiency, but not displace them yet. So productivity is still below its long-term trend, and it is starting to rise again after the. It's interesting that the COVID spike is very much like the GFC spike. Spike down, spike up in productivity. But certainly what we're not seeing at the moment, it is early days yet for AI, but we're not seeing any massive spike in productivity.
Yeah.
This is software development job postings on Indeed in the US. So currently the index is around about 70, which is where it was. Is that a COVID dip there?
Yeah, it is. COVID dip.
Huge spike. But is this the effect of AI or is this the effect of a slowdown in the tech sector? Question.
Don't know. It's interesting though. Are we actually seeing the effect of AI here?
So my son works in software development, and they use AI a bit for coding, but it's useful. It's a useful tool at the moment. So we have the innovation trigger, the peak of expectations, which is inflated, the trough of disillusionment. This is like 2000 tech bust, boom and bust. The trough of disillusionment, which lasted quite a few years, and then the slope of enlightenment and the plateau of productivity, where basically it's been adopted by everybody.
Yeah. So
there's no reason why AI. I mean, AI is going to continue to grow, but just like the internet continued to grow and develop and become more sophisticated. So
yeah, the point is, it takes 20 years, and everyone's expecting immediate effects, and you know, investing a lot in it, but it's not showing up in the productivity numbers yet. It's like, you know, the internet. It took 20 years.
Yeah, I think.
Okay, so Donald Trump, sadly, is the strong favorite to be the next president of the United States. And one of the many things he has said is that he intends to replace income tax with tariffs on imported goods. So cut taxes for Americans, raise the money instead by raising import tariffs on, you know, Chinese goods. Can he do it? In a word, no. I mean, the maths is quite easy. Income tax raises around 2 trillion on total incomes in excess of 20 trillion. Imports total 3.1 trillion. So you would have to put enormous import tariffs in, and that would actually discourage imports. And so you just couldn't get to 2 trillion.
You'd also get substitution, wouldn't you? US manufacturers will start making stuff.
Yeah, precisely.
And
Which,
therefore,
I mean, presumably he would consider a success. But I mean, how are they going to do that with unemployment at very low levels?
I would also say, Keith, your last bullet point, punitive import tariffs would antagonize US allies and partners, provoke worldwide trade wars, damage global economic welfare, undermine national security, destabilize global financial system. I don't think he cares about those minor things.
Yeah, sadly, Richard, I think you're right, and that's why we should be afraid. So the Peterson Institute have looked into all this, and they calculate the most he could raise would be 780 billion, so less than half of income taxes.
And presumably, if he did that, there would be a knock-on effect on the economy that which would affect other tax revenues in a way that's very difficult to calculate.
Yeah, and in particular, you know, inflation would shoot up. You know, you're raising the price of all the imported goods by what, 50% of that the import price. And also, other point, it would be deeply regressive, because the rich mainly consume services and they pay income tax. The poor consume goods, they don't pay income tax. So this would be an enormous tax transfer to the wealthy. You know, why on earth he's you know, so popular, I just don't know. Anyway, the dollar would rise because you're changing the balance of payments in your favor, reducing imports, and that would cause the dollar to rise until you got to a new equilibrium where US exports became less competitive. So the overall effect of all this would be lower trade, lower growth, lower employment. And reminder, the Great Depression was exacerbated by the Smoot-Hawley tariffs that created a downward spiral in world trade. So, bottom line, it would be a total disaster, increase inequality, not raise as much money as he would expect, lead to higher unemployment, lower trade, rising geopolitical tensions. He might still do it. On to inflation watch, Richard.
Thank you, Keith. So figures out recently, we got EU inflation CPI at 2.5%, which was down, and core CPI at 2.9%, which was unchanged, and the interest rates unchanged. And Japan inflation CPI was up to 2.8% in May. Of course, CPI was up to 2.2% also in May. Their interest rate is still only 0.1%, and their currency is being clobbered, as we saw on that chart that Keith showed earlier. And the Bank of International Settlements finds that expectations for falling inflation had an important role in bringing inflation back down. So if you can manage inflation expectations, you actually manage inflation, is what they're suggesting here.
Yeah.
The IMF disagrees and thinks that inflation expectations are irrelevant.
Yeah. It's the, this black bar is inflation expectations, and there's negligible. So, this is the classic two-handed economist problem. The
Yes.
economists can't agree. Yeah.
And also they take very simple, very complex systems and try and simplify them to the point where they're basically the simplification renders it a non-viable model of what's actually going on. In fact, the best model for an economy is the economy.
Yeah.
So the BIS also calculates that inflation dropped in the most cyclically sensitive sectors, and that monetary policy works.
Yeah.
So what you have to remember is the BIS is the central bank for central banks. And if you're a fan of central banks, then de facto you're a fan of the BIS. If, however, you think central banks' only role should be in regulating the banking system of their country and managing but not having any influence on gilt issuance, then the BIS is a dangerous organization. That is the collective organization for a set of dangerous institutions. And I think we can see that we are beginning to understand that QE was a very bad, very dangerous thing. And QE was a central bank innovation. So I do actually think that we need to be really careful about central banks and Bank of International Settlements and their role in our economies.
Yeah.
Personal view. So medium-term inflation expectations have actually remained really quite stable.
Yeah. So amazing, actually, given the
Yeah.
spike in interest rates.
Yeah. I'm not sure whether central banks have retained their credibility or whether
Yes, the inflation targeting has retained its credibility.
yeah. So Prometheus was an unpleasant person in Greek mythology, wasn't he? Can you remember, Keith?
No, he stole fire from heaven and then was chained. The gods were angry with him.
Well done.
They
Gosh,
chained him to a rock, and
okay.
every day an eagle would come and peck at his liver.
Ah, yes. Okay. So he wasn't unpleasant. He was unpleasantly treated.
Yes.
But he did steal fire.
Yeah.
So Prometheus researches US inflation pressure index turned negative. US inflation does appear to be continuing to fall towards the 2% target, which, as we all remember well, was a target derived by a New Zealand economist about 25 years ago. For reasons that remain lost in the mists of time. Goldman Sachs core inflation tracker has fallen quickly and is close to the Fed's, it's the red line, close to the Fed's target of 2%.
Yeah, and so that reinforces what we've been saying, that one of the reasons that core inflation is high is because of these lagging,
Yeah.
ER.
Do they include the value of the S&P 500 in that index, Keith?
I don't think they do. No.
So do they?
Asset price inflation is not included, Richard.
That's my point, Keith.
Yeah.
The whole thing is a work of fiction if you don't include asset price inflation.
Yeah.
And you have the wrong economic policies.
Yeah.
Which we have. US used car prices down 24% from their COVID peak, but still pretty high, actually,
Yeah.
in historic terms. And then global freight rates, mainly because of the issue with Israel, Palestine, Hezbollah, and access to the Suez Canal and so forth, global freight rates are continuing to rise. And the price of Rolex is getting cheaper. So I think, what do you reckon, Keith? When it drops to about 3,000, do you think we should jump in?
Well, this goes back to our discussion about Fred Hirsch, Richard.
Yes.
This the whole point of Rolex is to make your neighbors feel jealous.
But is this because Rolex have responded by cheapening the product?
Well, apparently they're the most successful watch brand in the world.
Is that right?
Yeah, and they've rather than cheapening it, Richard, they have launched loads of very ultra luxury ones, so that within Rolex, when you bump into somebody with a Rolex, you compare your paltry Rolex, which only cost you 25 grand with their super duper Rolex, which costs 250.
So when you bump into someone wearing one of those keys, you have to clutch nervously at your wallet and your insurance.
Well, you have to ask, did you buy that in Thailand?
On the beach resort in Tenerife.
Yes. You know.
In summary, inflation is coming down.
Thank you, Richard. Right,
You're
on Recession watch. So reminder, banks continue to sit on massive unrealized losses on their investment portfolios.
But we haven't to worry because the central banks will bail them out because that's
Uh,
what the central banks are for.
I really hope they do. These are construction starts in the US. They've come down a long way,
haven't they just?
actually.
Yeah. And actually, if you look at that chart, they're as low as they've been since 2012.
So there's this, how long do you think it takes to build a new, retail park or whatever it is? 2 years?
But every component has dropped substantially, hasn't it?
Yeah. So, well, my point is that
Yeah.
at some stage, construction should start to slow. Has it finally done that with the minus 0.1% month-on-month print in May? He says. Bottom line, US economy does appear to be softening slowly. And on to good news. So this is a bit of a double-edged sword, this one. So scientists have developed an RNA pesticide that specifically targets the Colorado potato beetle while leaving all other species intact. And so they've created a man-made virus that they're intending to release out into the wild, and it will target a specific RNA sequence in the Colorado potato beetle, which will stop it from processing proteins. And so proteins build up in the larvae of the beetle, killing it.
So the problem with all of this research is we don't really understand the way genomes in different species exchange DNA sequence within the species and between species. And if you look at bacteria, so virus is actually a very important agent in bacterial evolution because it transfers pieces of RNA from one bacteria to another, and that's how one of the ways that antibiotic resistance is transmitted. So the danger here is that you release something into the environment which is specifically designed to do this, which is clearly lethal, and you have no way of knowing whether it will actually be picked up and transmitted into other species, and if that happens, what will happen to it. So it's really, really dangerous stuff.
Yeah, I agree, Richard. Yeah, when this is released into the wild, who knows how it will mutate or how other viruses will interact with it.
Just because you could do it doesn't mean it's a good idea.
Anyway, this is the good news section. It means it will decimate the Colorado potato beetle until it evolves to, get round it.
Perhaps you should title it Qualified Good News of the Week, Keith.
Yes.
Potentially.
Onto equities, Richard.
Thank you. The FTSE World Index continuing its climb up from the spring, up 11-12% for the year. FTSE All Share up 6.3, but it spiked up and now it's sort of dropped back a little bit. As I noticed today, it hasn't really moved very much. I guess the result of the election was widely known, and no surprise there. So the Euro Stoxx 600 up 8.1% year to date, but been pretty flat for the last few months. The S&P 500 just continuing to sort of trog up. It does a new all-time high, up 16% for the year, mostly led by the Magnificent Seven, and Nasdaq Composite up 21% for the year, continuing
amazing,
inexorable rise.
That's absolutely amazing. Since November last year, the rise has been just incredible.
Yeah, 45% or something, isn't it?
Yeah.
So the Russell 2000 is unchanged on the year. which says that the US, basically the US economy is sort of flatlining.
Yeah, I agree.
The Hang Seng down, actually only up 2.6% on the year now, and in quite a noticeable downtrend, I'd say. The Topics is shooting up, but that's because of the weakness of the Japanese yen as much as anything else.
Yeah, agreed.
Bitcoin has fallen sharply actually over the last couple of weeks.
Any ideas, Richard? What's
No
going on
idea,
with Bitcoin?
no idea at all, actually, Keith. No, none whatsoever.
Just very volatile.
Yeah. So the pound is unchanged on the year, and just really quite a tight range between 126 and 128 mostly.
Mm.
The euro actually is in quite a gentle downtrend from the start of the year, and it's down 2.1% on the year against the dollar. The dollar index is sort of flat, and depending on where you draw the bars of the range, it is within a range of 104 to 106 or 100 to 107 or the VIX really very, very low, and question, is it time to buy the VIX? Well, in theory, probably yes. In practice, well, be careful.
Yeah. Well, it's just extraordinarily low numbers. People are very complacent about the market, which is marching steadily higher. So perhaps they're right to be.
Yeah, exactly. S&P 500 has had this really powerful start to the year. As you can see, it's outperforming the very good performances that you typically have had in either election years or non-election years, but it's way out ahead
Yeah,
this year.
and that's against the background of a weakening economy.
Yeah.
Extraordinary.
And the Nasdaq index is the most overbought since 2018. I wonder how it compares with 1999.
I agree.
And shares that dominate each decade tend to underperform subsequently. I think we've sort of shown this before. And the problem with outperformance, overbought, is it's a sort of it's a relative measure, but
Yeah.
doesn't just because something overbought doesn't mean it can't stay overbought.
Yeah, but long term, you don't want to buy it here.
No,
I'd say.
I would agree with that. And AI, as we know, is the biggest winner, and AI risk stocks fell 12% in the first half.
Yeah.
Weight loss drugs also did very well. Well, there's been a bit of negative press about weight loss drugs recently. I saw something about them potentially causing blindness.
Yeah.
As a rare side effect.
Yes, that's right. It's apparently rare, but the market likes it.
And insiders are selling Nvidia. I could understand why.
Yep.
If
So
I was an insider, I'd be selling it.
well,
Sounds like a fine
if the
thing.
CEO's got something like $100 billion worth of stock,
Okay.
you'd certainly take some off the table, wouldn't you?
Yeah, I definitely would. Could buy a new mainsail for that. And the outperformance of the tech sector. This is a comparison with 2000. The outperformance of the tech sector is now at a record high.
So Nvidia's granted stock options to everyone, all their engineers, because the share price has gone through the roof. So like all the engineers are now worth 10 to 20 million. So quite rationally, they're cashing it in and going to the beach. So the company is suffering from an exodus of its engineers due to the generosity of its options policy.
Yeah, frankly, for most people, 10 to 20 million is more than enough to retire on.
Absolutely.
And so they probably can't entice them back.
Yeah.
All we need is a good, strong bout of inflation, Keith. So US consumers are not bullish about business conditions, but they are bullish about stocks, which makes perfect sense, doesn't it, Keith?
Yeah. Well, that's where we are.
Financialization of the economy.
Yeah. And that's when interest rates are, very high.
Yeah, and the dissociation of the real economy from the financial economy.
Yeah.
And QE and excessive quantities of government debt and central banks. And here we are, weight loss drugs, as is in the new tech. Are they going to go up to the so basically the market cap is enormous, and the net income is growing, but not growing to the extent of the market cap.
So the market cap's up 1,120% over the last decade, but revenues were only up 70%.
I sort of wish I'd spotted this about 4 years ago, Keith.
Well, same here, mate.
We're going to have to do what the Tory party is doing, go have a real reinvention moment. The dividend yield on the S&P 500 is really low, 1.3%, even with high interest rates, which is what you would not expect. The Russell 2000 has underperformed the S&P by a record margin in 2024, half one, going back to 1979, so going back 45 years.
Yeah. So that's the difference between the real economy and the tech sector.
Yeah. And our breadth is abysmal, i.e. most companies aren't doing very well, and a few companies are doing fantastically well.
Okay, thank you, Richard. On to commodities. And it was generally a good week in the commodity sector. Actually, oil was strong. Industrial and precious metals also strong. So looking at energy, oil up 1.6% on renewed tensions in the Middle East. WTI up 1.5%. Now, after a run of builds in the US, we had a big inventory draw. So last week, the oil inventories fell by an enormous 12.5 million barrels, actually 13 million barrels, excluding the SPR. So US oil market very much undersupplied last week. The US crude production was steady at 13.2 million barrels. We're entering the second half. Reminder, the EIA have been forecasting that US oil production will resume growth in the second half. In the first half, still not at their peak at the start of the year. Baker Hughes rig count, it continues to tick down despite high oil prices, down 6, down 21 on the year. So when we look at the oil price and break down the factors that have driven it, then it's demand, not geopolitical risk, that has been behind the recent rise in the oil price, according to Bloomberg Economics anyway. And in the next year, the market is expecting oil supply to increase and the market to move into oversupply, but no major oversupply.
That's interesting, Keith, isn't it? Just on the oil supply, they're looking at the long term. And as people know, I bought a couple of ETFs in your sector probably about 6 or 8 weeks ago. But you get conflicted. You get some views which say there's never going to be a shortage of oil.
Yeah.
And then you get other people saying there's going to be a massive shortage of oil, and it's really difficult to know where the truth will lie.
I am very much in the camp actually that I think the oil market will be oversupplied for a bit, and I also think that we talk about oil production numbers a lot, and oil production is not actually the metric you really want to look at. It's exports, and one of the things I think people don't pay enough attention to is oil consumption in the Middle East. So a lot of electricity production in Saudi Arabia and the rest of the Middle East has come from burning fossil fuels historically. But now they are adding wind, adding solar, and that means they're burning less oil. That will free up a lot of oil for export.
That's interesting.
But in the last few weeks, investors have been giving up on the energy markets, selling equities, probably buying tech, frankly.
Yeah.
These are Dutch natural gas futures. The rise appears to have stalled, down 3% over last week. UK natural gas futures, good news, down 2.6%. US past peak, recent peak, down 13% on the week, down on the year again. Coal had a little bounce, down 6% on the year. Uranium up a little bit, but down 6% on the year. And certainly the bull market seems to have paused. On to industrial metals, Richard.
Thank you, Keith. So aluminium pretty much unchanged on the week. Cobalt dropping, actually not this week, but stair stepping down. However, have just read this morning that there's a couple of hedge funds that are buying physical cobalt.
Really?
Now, I'm actually not going to buy physical cobalt myself, but it's quite interesting to see that perhaps it's fallen so far on battery technology, sort of lithium batteries have dropped out of favor so much that people are seeing an opportunity there. Copper, it rose substantially, didn't it, in the first part of the year? Probably too far, fell down, and now it seems to be rising again.
Yeah.
It's up 5% on the week.
And that's despite Chinese PMIs being quite weak. So that suggests that, copper is in short supply again.
Yeah, and also despite that slowdown we've seen in US construction.
Yeah.
But of course, a lot of it is being used now for electricity transmission. Chromium, unchanged for the week, pretty much unchanged for the year. Iron ore up 6% in the week, although down substantially over the year, 20% over the year. Lithium unchanged, been unchanged really since late autumn last year, early winter, although down 5% year to date. But that really big decline has clearly bottomed out.
Yeah.
Is the next move up? Depends on, well, it doesn't just depend on electric vehicles, but electric vehicles are a very significant part of lithium demand, aren't they? Neodymium unchanged on the week, but nearly 20% down on the year. Nickel is up a little bit on the week, up a little bit on the year.
Yeah. Reminder, should be in structural oversupply from Indonesian production in the coming years.
Yeah. Tin, I wonder whether tin is getting ready to break out actually in an upwards direction.
Yeah, that looks like it, doesn't it?
Yeah. So zinc is up 0.7% on the week and 13% on the year. Seems to be possibly resuming its upward climb as well. And basically, the question is, are we in a, are all industrial commodities basically in an uptrend, or are a lot of them in an uptrend? And it may be that some of these are now resuming their uptrend.
Yes, it might, maybe. You'll notice ferrovanadium has died a death.
You know what that means? It's a strong buy, Keith.
Probably.
So precious metals. So gold. That's quite a long period of consolidation, but it hasn't dropped, has it? So it's sticking above 2,300 basically. Bounced up to 2,364 basically this week, and still 15% up on the year. And I think it's going to break back out upwards in due course. I certainly hope it is. Silver has had a good week, but it's still below its recent peak of 32. We're up 26% on the year to date.
Yeah, next week I've got a bit more time and we will do silver.
Good. Platinum is sort of sharing gently in the precious metal rise, only up 3.5% year to date, but it's looking a little bit more positive than it was a couple of weeks ago. Rhodium is basically flat, and palladium is up 12% on the week. And has it fallen too far?
Yeah, interesting.
But it's a noisy chart, isn't it, Keith?
It is a noisy chart, but it's very volatile.
Yeah.
Because unlike rhodium, which is dead as a dodo, it's traded.
Yeah.
And onto rates, and another terrible, terrible week for me. So this is the yield curve. The blue line is last year and the black line is now. And what's really caught me out is that last year, the yield curve was declining. So you had rates at the long end falling steadily across the curve. What's happened is there's been a shift in the curve so that rates at the long end have risen despite the fall in inflation and lower interest rate expectations. And that has absolutely killed me. So not looking very clever. The same has happened in the US. So it seems that investors demanding a premium for holding duration risk, for the risk of being exposed to government debt long term. And liquidity in the bond markets in the US is very poor. And that's a problem given the enormous issuance. And the fall in long bonds in the US has come despite record inflows to the ETF, which is concerning. Now, the term premium on the UK 10-year remains negative. So if we go back to the yield curve, the black line is now, you see, up to the 10-year at least, the 10-year yield is the sum of expected interest rates over that period. It's after that, there's quite a large rise in bond yields, which I suspect means that the term premium has turned positive over that period. But the market and the Fed have been talking about interest rates being higher for longer. Nordea estimate that the neutral rate in the US is falling quite quickly. So that implies that interest rates in the US will come down if the economy slows further. So the light blue line is the US 30-year rate. The white line is the oil price. And it seems that the 30-year rate is simply a function of the oil price, frankly, with a lag. Okay, on some charts, this is the UK 2-year. So the UK 2-year over the last month has done nothing. So 2-year interest rate expectations remain towards their lows for the year, but the 10-year towards the highs of the year. And they've risen substantially over the last month. They've caught me out. 30-year, the same. US 10-year, actually, so US 10-year has not risen as much as the UK. Surprising. German Bund yield. France. Italy. Greece. So concluding comments, well, it's all changed today in the UK with the new Labour government winning by a landslide. They inherit a whole load of problems, but hopefully it seems that Rachel Reeves, the new Chancellor, is experienced and will be prudent, we hope. Fingers crossed.
Yeah.
In the US, Joe Biden is desperately clinging to the Democratic candidacy when every rational human being thinks he's far too old to run. His ego is endangering his country and the party. Be afraid. In economics, the US economy, as we've shown you this week, I think all the data for the US we showed you was weak. So non-farm payrolls are out later today. Will it confirm a weakening labour market? Richard, how was your week?
So quiet week, Keith, as ever. Well, as usual, no trades. As we saw, gold and silver basically have been consolidating for a couple of months really now. So not a great deal to report. One thing I did notice was that, and I don't know why, Sibanye-Stillwater suddenly spiked by 10% the other day.
Wow, fantastic.
But I don't actually know why, and I haven't looked to find out. But it's sort of suggestive that there is movement in the precious metal, the platinum group metals generally.
Yeah.
So, it was like that. How about you, Keith? How was your week?
Well, I had another absolutely terrible week, down 3.1%, taking me down to almost my lows for the year, which is very unpleasant, having by far my worst year ever. And it's market's not doing what I expect. So I've been absolutely right on inflation. Interest rates should be coming down, but that's actually has not translated to falling long bond yields. So very depressing. I have got it completely wrong. But medium term, I still think that in interest rates come down, what I need to bail me out of this disastrous trade is a slowdown in the economy and interest rates to go from being restrictive to being stimulatory. and the US is slowing. We've been calling for a recession in the US for a very long time, and it hasn't happened. Will that happen? On the flip side, Donald Trump, if he came in, then more fiscal irresponsibility from him could blow up the US bond market, and that would be presumably bad for gilts, which appears to be just following the US market. So the bottom line is that I've got this wrong and I'm totally trapped in this trade. I think that yields are too high, but and I'm kind of committed to holding them until I find a better alternative. I've lost a lot of money. I'm not looking very clever. I'm not feeling very clever, but I still think that interest rates have to fall and bond yields should fall. Richard and I have had incredibly bad news this week in that our second largest angel investment went bust, or has actually, that's not true. It has there's been a takeover approach which the management are recommending that would leave shareholders with nothing. And I'm very angry about this. And anyone who follows me on LinkedIn can see my opinions. But we are going to be polite here, and we're not going to discuss the failures of management, which are very disappointing. And, what I'd like to say about the failure of this company is that we have got very little information out of it over the years. And what you see me doing every week is talking very openly, honestly about my own personal failings as an investor. I started this off when, frankly, I was doing well. Part of the reason that, I'm now in trouble with my portfolio is that after that great period of performance, I succumbed to hubris and thought I was the world's greatest investor, and I took on far too much risk and I got it wrong. But every week, I deal with it. I talk openly to you. I tell exactly, I'm basically just honest about whatever's happening. And I think when things go wrong in your life, you have to deal with it. You have to, not hide under the bed and, disguise your failings. The problem with this company is that when things started to go wrong, it shut up. It did not engage. It didn't share any information. And I can bet you, I think I know what went wrong with this company, in that failure to deal with the business model going off track. If you are unable to face that full in the face and deal with it, and you just hide, then what you do is you continue with the failing strategy, hoping that it will get better. And you should never do that. You've got to deal with your problems in life. And this company, it simply shut up, didn't share any information with investors, and it's now failing. At no stage did it share revenue, cash flow information. At no stage did they get on a call with investors and say, this is what's happened, and that your shares are worthless. Even in the final document, the shareholders' approval document they've sent out, they do not say the bid will leave shareholders with worthless shares. The value of the shares will be zero. You have to work that out with yourself, because they do not have the courage to tell you that boldly. I thought it was absolutely shockingly poor.
Bit of a rant, Keith, if I may comment.
Yes, bit of a rant, but I'm sorry, but very upset about.
I know, and I completely understand. I'm very upset too, and
yeah. So apologies for my rant, but Rich and I have been involved with this company since 2016. Yeah.
Yeah. Long time.
So yeah, bottom line, I'm not having a good time at the moment, but thank you all for watching. The dangers of being an angel investor, and I think Richard and I, this is yet more evidence that angel investing is very tough, and yeah, probably best not to do it. bottom line.
Well, I've sort of reached the end of my angel investing career, I think.
Yeah, well, that's the final straw for me, actually. I'm not doing it anymore. Full stop.
Yeah.
Okay, so that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.